The broadcast is now starting. All attendees are in listen-only mode.
Well, hello, everybody. This is Ken Cavullo from the Mid-Michigan chapter of Better Investing. I'll be being joined today by my good friend Mark Robertson and by Kim Butcher. Also, Cy Lynch is going to be with us today. We're not quite sure if Hugh is going to be able to make it, but we will have at least 4 folks presenting stocks. Right now is the time, however, just to chat. We will be starting the formal program at 11 o'clock today. We're giving this Saturday session a trial period. I hesitate to say that our enrollment, our registration for this particular Saturday session was much lower than our normal registration. So we'll see how many people a session like this attracts, but it's definitely a work in an experience that we're testing. We're not going to stick with it necessarily.
Well,
So if you have questions right now, if you'd like to be unmuted, if you'd like to have us check your sound, now's the time to raise your hand, or you can type text in the question box, and we'll be with you starting promptly at 11 o'clock Eastern Time. Mark, you were trying to get a word in edgewise, so jump in now, okay?
I'll jump in and just simply say Happy New Year to everybody, and also it's just a solid reminder, there's a reason that investment clubs meet at the same time on the same day, once a month, and that's part of it. So we're actually off the radar with our regular time, and that causes some challenges.
Yeah. I was fascinated to listen to Kim before we turned the sun on for everybody that her investment club doesn't meet in December either. Ours takes our normal December meeting, which is the last Wednesday of the month, and moves it to the first Wednesday of January. So that's our December meeting. Still gives us 12 meetings a year because we meet twice in January then, but sometimes it doesn't leave us the opportunity to be as nimble as we might want to be. I was really interesting, Kim, to hear that you had put in a limit order so far down for that one stock. I think you'll probably talk to them about it when you present the stock today, so I won't spoil your whole concept there. But I found that really interesting and maybe a good strategy for our November meeting. Especially if we have some cash.
Yeah, we did that, but we did it on more than one stock, and I'll tell you the other ones later.
Mark Roy from Sacramento is saying this isn't the first time you've made him get up at 8 o'clock in the morning on a Saturday. Okay.
You're welcome, Roy.
Remember, Roy, it's all because we like to make money.
Hey guys, I've got the all-time best autocorrect. I was just catching up on some messages from Facebook, and I got one from Marty Eckerly. I don't see Marty on the list here, so we'll talk about him while he's not here. So I basically said, back at you, Marty, and it autocorrected to Smarty. So he gets the best autocorrect of all time.
Hey, Mark, why don't you hit the play button on your computer, and then this slide will suddenly make it fill the screen for us then.
Oh, am I holding
right now you're in edit mode right now. Yeah, so hit the play button. No, not the play button on GoToMeeting, the play button on your PowerPoint.
Oh. That one you mean?
That one I mean. There we go. Now we have it filling the screen. Okay.
Yeah, I'd be surprised if Marty doesn't stumble in here anytime now. No, I'm definitely having some.
Out of curiosity.
Go ahead, Kim.
Go ahead. I was just going to ask, what sequence are we in? Presentation.
What sequence? Well, it could be by performance ranking, or it could.
I'm not saying anything.
Okay. I took out the gecko.
Good morning, geckos.
Hi, Asai. How you doing, huh?
I'm doing well, and you, Ken?
Pretty good. Sai, you're going to go mute for just a moment while I turn you into an organizer here, okay?
All right.
Well, I'd be
Hey,
interested.
you're back. You should be back on again, Sai.
I'm back.
Great. Okay.
Hello, Kim and Mark.
Hi, Sally.
Hello, how are you guys?
Just fine.
Hey, Sai, I'm going to ask you a really dumb question, but I promised my chapter I would ask and then see if I could do any bargaining of any kind. We'd like you to speak at an event up here in March, but the date they chose was the Saturday before Palm Sunday, and I'm guessing that's a date that you'd like to be in your own church for. Am I right?
Yes, that would
Okay.
be something I like. And the problem with, let me just look real quick. Oops, I closed my calendar out for this. I'm in Florida one weekend, and then I've committed to helping. I'm on a nonprofit board of an animal rescue, and there's a Conyers event that weekend. So March is kind of a full up month.
Okay, so the third, that includes the third then. That's filled up also, right?
The 3rd of March, I think, is all right.
Wait. Easter's in April this year, isn't it?
Correct.
Right, so it's not the 3rd of March, it's the 3rd of April, I think, which is a Saturday.
Okay. Yeah, that would not be good, and I think the
Okay.
Saturday before I am open. If I again,
Yeah, well, that doesn't work for our 2 chapters here. So,
I see. Yeah.
So we're gonna keep you on the list and try to give you a little bit more lead time. Okay.
All right.
We're working with another chapter who doesn't do events very often and doesn't understand calendars that are few speakers in better investing. Their calendars get tied up real quickly, you know.
Right.
So, and I guess that's hard to understand if you're not running around the country trying to talk to people all the time. So,
And
yeah.
I guess speaking of that, I'll go ahead and mention to you all so we can plug it at some point. But I am in Sacramento for their Breakfast of Champions, February the 9th.
Oh, let's put that on the list. That's always a nice event. I've been there 2 or 3 times. Yeah, that's a nice event.
Yeah.
Herb, one Kim.
I've been asked to present at the Atlanta Investors Fair in August next year.
Oh, that's right.
I'm going to be there as well. So.
Yeah, I just saw your hotel inquiry, Kim. I guess I should tell you, but basically, there's I think it may be a Marriott of some sort now in downtown Decatur. That's the closest decent hotel, and then you can look at the North Lake area on La Vista. That is, there's a Courtyard there, I believe a Holiday Inn Express. Both of those would be fine. There's a good number of hotels in the area, but to be honest, some of them, if they're national chains, you're probably safe. But
Okay, I've got a young lady who's getting interested in stocks, and she lives in the Atlanta area. I think in the Buckeye? Buckle?
Buckhead?
Okay.
Yeah.
If she's in Buckhead, she should be able to just commute, especially on a Saturday. Yeah.
Okay.
Yeah. If she's in Buckhead, I mean that's 20 minutes away without traffic.
All right. That'd be good.
I have a hand in the air, and I'm going to unmute you. Herb, go ahead.
Hey, good morning, everybody.
Good morning. How are you doing? Are you in Florida, Herb?
Yeah, we're in Bradenton right now with our friends and celebrating Christmas and New Year's with them.
Great. Terrific. So what can we do for you?
Mark, I had sent you an email about Express Scripts.
Yeah.
That so far you show the price at $1,947.33.
Yeah, it should be fixed. Did it come back? The problem come back?
No, it's still coming up with that price range.
Right, and I think Express Scripts is gone, right? Weren't they acquired by somebody?
Well, they were supposed to be,
I think if you look,
but that's why.
the last price on Yahoo actually shows up as December 20th, I think.
So
I think the transaction must have closed, so you're probably seeing some noise on some unrelated ticker. So
that's what I was wondering.
I think on our next database update, it actually disappeared.
Okay, and then it should be the next one. It just really skews my wife's portfolio up pretty bad when you show that.
If you rerun it, I put the current price in manually.
I just pulled it up this morning, so.
Okay, then it did override with whatever that bogey is. It's pulling some weird off exchange number.
Yeah. So, but other than that, everything's going good in northern Michigan and down here in Florida. We're gonna on New Year's Day we go back to Destin, so we'll be back there for about 2.5 months.
Great. Herb, I hope you can join us at our board meeting next week if you get a chance.
Yes, I've got it on my calendar.
Tremendous. Okay, I'm going to put you back on mute, Herb. I have
I show 3 minutes, Ken, if that's what you're looking for.
Okay.
Shout outs to all around the country. I'm seeing Pittsburgh represented by Mr. Strategos.
Mark Roy is saying, looking at the PowerPoint, is it true that east of the Sierra Nevadas is 2 days behind California? And Roy, I'm not quite sure what you're referring to, but maybe that's an error of some sort.
On the PowerPoint? Oh, it's often right.
Oh, you're dated incorrectly. Okay, I got it. There we go.
That'll make him feel better.
Okay. We still have a couple of minutes if you'd like to test your sound equipment. We're at a very new time for us right here and a very low registration, so it'll be a nice cozy group today.
But, come on, we're making some of these people who can't be with us on Tuesdays happy, so I think we them. I mean, those other grumpy people are being grinchy with the regular Tuesday attendees.
I would like to give a special shout out to all the Mid-Michigan folks that are here. I notice 8 or 10 of you out of the registration. You're representing a pretty good portion of our audience today, guys. So hang in there. And Mark, I'm going to go quiet, and whenever you're ready to start, take it away then, okay?
Okay, well, we can go right ahead because we've been recording the whole time, so we'll have to figure that out.
All right.
Maybe that's a New Year's resolution. But good morning, everybody, and welcome to the final webcast, at least for us, of the year 2018. It was a great year until 3 months ago in the stock market, and that Simpsons chart that you see in the center of the page actually come to fruition starting in October. But we're going to actually talk about how the community has such a wonderfully different perspective. And in fact, we're going to share that we have hit new all-time highs. All this turbulence and carnage. And
okay, Mark, I'm going to interrupt you. You're cutting in and out. Is your mic moving around at all?
No, it shouldn't be, Ken. I'll try to sit.
Okay. All right, you are cutting in and out, so I'll give it a try.
Why don't you go ahead and take over the introduction, and I'll try to be a little bit quieter.
Okay, well, let's go to the next slide then and talk about the standard disclaimer. We are going to be talking about real companies in real time. Everything we do is for illustrative purposes only. It's for education. and we urge you to draw your own conclusions and make your own decisions before any buys or sells are handled in your own portfolios. We might own some of these stocks in our own portfolios, and we'll try to tell you about that if we remember, but we don't guarantee that we'll be able to tell you each and every time. I have something to talk about the email reminders. So if you could kind of listen carefully, we've been experiencing some problems with the URL that goes out in our email. And Mark, I'm getting all kinds of stuff on the screen, and you're on the edit. There, yep, there we go, okay. We've been in contact with LogMeIn, that's the company that now owns GoToMeeting, and they've discovered an issue with their sign-in process, and they've given us some hints to work around in case you press the URL in our email or in the manifest posting, and it takes you to an unexpected place. The first thing that they suggest is that you refresh your browser. Now, each browser has a slightly different way to refresh it, but it should be basically some type of an arrow that allows you to press it, and it just brings in all new information and cleans up the URLs that were being stored in cache. If that doesn't solve the problem, and if you try to register and still get sent somewhere else, we're going to put this phone number in all future postings, but we can give the phone number to you. It's toll-free 888-621-0537. You're calling LogMeIn at 888-621-0537, Mark at the end. And if you're having access problems, then that's the number to call. They have been able to fix those problems for anybody that's called them, and they will continue to work with us. Meanwhile, for most of you, the process remains simple and straightforward, and it shouldn't cause you any technical problems. If you could drop Natalie or myself an email when you do experience a problem, that is going to help us track down for LogMeIn what is going on at our end. So if you do try to log into the program, you get sent somewhere else. If you just would drop an email to nkavula1 or kkavula1 at comcast.net, that'll help us work with LogMeIn. Thanks a lot for that. Let's go to the next slide, Mark. Here's our standing agenda. We stick to it pretty closely, and we'll try to give you a good hour and 10 minutes of program right here. Notice we do have 4 stocks that we're going to be talking about this evening or this afternoon, or this is morning, isn't it? This morning. We are pretty sure that Hugh will not be able to join us this evening. So we do have Cy Lynch from Atlanta, Kim Butcher from originally from Southern Indiana, but in Florida right now, helping out with her folks, and Mark and myself from Michigan area right here. Next slide, Mark. The goal of the roundtable has always been to identify one of our best stock picks on any particular month that we come with you. So that means that we will repeat occasionally, and that means the portfolio is going to be pretty large. We've been doing this for a fair number of years now. I think we're in our 8th season, and that means that this is a tracking portfolio. It's not the kind of portfolio that you'd put together as an investor, but rather we're keeping track of our ideas, seeing how well they've done, and then seeing how well the composite has done for the entire group. We'd love to have a long-term relative return of about 5% or better. And relative return means we'd like to do 5 points or more better than what the market has done. So we track the investments that we make. We track the exact same dollar amounts as if they were invested in the total stock market index fund, and then we compare the two. Our tracking portfolio is the Wilshire 5000, which represents 5,000 of the most highly traded stocks on the stock market. We'd like to have accuracy, that means beating the market, of between 60 and 70%. And here's how we're doing to date.
All right, I'm going to interrupt for just a second to see if I'm continuing to go in and out. And
No, it sounds like it was before at the beginning, Mark. You're very clear again now.
okay, that's good. I'll try to minimize. I might shut a couple of more things off when I go later. But I had lunch with a group of Rhinos. That's investment professionals. We call them Rhinos for reasons we don't need to cover here. But we were talking about this notion in general and our objective of shooting for 5%. And I'd just like to share that they unanimously told me that's impossible. It can't ever be done. So here you go. Next slide. Go ahead, Ken.
Well, we're doing it, and we've been doing it for about the last year. When this graph moves into that light blue section above that dotted red line, that means that our portfolio is beating the market by 5+ points. So back somewhere around the middle of our 7th year, maybe the first third of our 7th year, was the first time we moved above 5%, and we've stayed there. It hasn't been consistently up. We find that this portfolio actually does a little bit better when the market's having a little bit of turbulence than it does when the market is moving in a very stable, straight fashion in one direction. So we're at a new time high. That relative return of 7.4% means that over the entirety of the portfolio, going back 8.5 years now, over the entirety of the portfolio, we've year in, year out, we have an annualized return that's beating the market by 7.4%. The Wilshire 5000 would have returned 8.2%. This portfolio has been returning 15.6%. The only place that we're slightly disappointed is, again, we'd like our outperformance accuracy to be about 60, 65, 70%, and we've been down around 50%. In other words, half of our choices have been helping us beat the market by this 5 or more points. So I'm very pleased with the results. We told each other way back when this chart had ones on it for the years, we told ourselves that it would be a slow, steady process and that we did not expect to get rich quick. But I'm not certain that I ever believed we'd be able to move this thing up to this relative return of where it is right now, about 2.5 points better than the market. I'm sorry, about 7.5 points better than the market. I'm just not sure that I ever thought that would happen. Of all 4 of us that started this grand experiment, Cy was the most confident that it would happen. Slow and steady wins the race, and he kept reminding us about the tortoise and how you just had to keep picking good stocks. These gentlemen that I've been working with and these women, these ladies that I've been working with have been absolutely phenomenal in their picking of great stocks. And that doesn't mean we don't pick some clinkers. We certainly do pick some clinkers. I'm the poster child for clinkers, so I can give you a long list of my misses. But when you hit as many hits as we've hit, you can see the kind of return that comes into being. Mark, you want to do some more commenting?
Yeah, I guess the thing I would point out is every once in a while we do pick one of those. You call them clinkers, I might call them stinkers. And they do happen. And I think kind of a theme that I've been stuck on here for the last several months is we shouldn't be surprised by that. You know, little things like Apple dropping 40 or 50%. I can show you where it's done at 6 or 8 times. Therefore, we should not be surprised by that. And there's all kinds of things out there like that we should not be surprised by. and this is one of them. And again, we very carefully form in our community. We form expectations. We do our stock studies. They're not all going to work out. That's what the rule of 5 is all about. We might spend a little bit of time talking about that, but the thing that always comes back and restores me, especially this time of year, is this notion of, for every stinker that you have, there's an Apple or a Cognizant Technology. That's size Q to chime in. Those companies, the gains that we make on companies like Cognizant, Apple, Amazon, little companies, some of Kim's have just gone off the charts. I see Nick Strategos is in the audience. He's got a few selections that he's made that are up still at this time, 40 or 50% greater than the market. The gains from those so monstrously dwarf the stinkers that I think we lose perspective on that sometimes. Si, would you like to comment on how Cognizant's been kind to you over the years?
Cognizant has been very kind and keeps defying, I think, market expectations. The one thing, getting beyond just Cognizant, but all of the companies that you mentioned, I would remind everybody, all you can do with a company is lose everything, which is 100%, but it's your total investment. Your upside, however, is theoretically unlimited, but practically doubling, tripling, quadrupling, which we have seen with some of those companies that Mark has mentioned over the long term, far exceeds those stinkers, clinkers, clunkers, whatever, that at worst go to zero. And of course, in most cases, we get out before they go totally to zero.
Absolutely. Kim, any thoughts on your experience during this?
I always recognize, and if I can laugh at myself, the market is a passive crazy person. And I always feel that, if you've got a great stock, the hardest thing to do is to sit on your hands and do nothing. So when you have those great stocks that are offered to you, you grab them and you sit and wait. The market recognizes it. So we can do great performance. We just don't know when those stocks are going to give us a 40 or 50% return above what the market's doing, like some people have. Patience, that's hard.
Patience is hard.
Mark, I think it's important to read this graph again too before you move off of it, and look that since our 5th year, since the end of our 5th year in existence, we've never been below the market. We've always beaten the market. Now, and a couple of those dots are only just a touch above, but we've been in this relative outperform mode now for a good 4. If you discount that one dot right before the end of the 4th year, we've been in this relative outperform mode for over 5 years now. And that's the way that you build wealth. I'm just confident about it.
Yeah, moving up the ladder of returns. I thought we'd spend just a moment reminding what a different year 2018 has been. And a year ago at this time, we were sitting around talking about 15 consecutive upward months in the stock market that had never been done before. And this year's been obviously a little bit more turbulent, especially here the last 3 months. And you can see the size of those red bars are as big as we have seen during the lifetime of the round table. But our metal's being tested, but we're also being presented with opportunities. We have to somehow use a decades approach that requires patience and discipline, and to take advantage of those when they happen. Any thoughts on 2018 versus 2017, guys?
Yeah, I like 2017 better, Mark.
There's more opportunity.
Well, I think the biggest thing to remember about all of it is patience, first of all, and the corollary to that is this too shall pass. And unfortunately, as good as 2017 was, this too shall pass. And we've seen that happen in 2018. But remember that 2017 was a kind of a perfect storm, to use a cliche that I don't really like, but a perfect storm of opportunity. You'd had a so-so U.S. economy that nobody really believed in, that finally people started believing in 2017. Europe had been teetering on recession and became a fast-growing opportunity. China continued to grow well. Japan also had been in recession and started to grow. You basically had all worldwide economies coming together, and the market and the economists were convinced we're growing. And then you had some psychological dynamics on the positive side going with the Republicans gaining complete control of the government and some expectations that went with that. Then 18, you've started having a major period of uncertainty, some economic uncertainty on a global basis with some of the economies that I mentioned, as well as some political uncertainty, particularly in the United States. And probably the thing that the market hates the most is uncertainty. And just look at this chart that you have here for 2018, and remember we had a huge boom market in January where the market was up by about 10% year to date. And then in February, it gave up all of that. And we had an actual correction in February and then went up to all-time highs in October. And now we're definitely in correction territory, potentially even bear market by some indices. So what does 2019 look like?
And nobody knows. When we were getting warmed up, Ken, we were talking about who out there remembers the great correction of 2011. It's right there on the chart. I don't remember that.
You broke up. I didn't hear the great correction year, Mark.
2011. If you look back on the left-hand side of the chart.
Yes.
And I guess the one thing I would share is look at the size of that white bar in the middle of 2011 after the correction. And I would go so far, I think we'll see one of those in some people's month, probably during 2019. So anyhow, just to put some scale to the enormity of what has happened, this is the chart that we prepare on a weekly basis. We're actually tracking quarters on here showing the value line arithmetic average versus the value line low total return forecast. That's actually the median low total return forecast. And you can see that the price correction that has taken the green bars below the blue trend line for the first time in a few years is fairly massive. We've got a pretty good white gap there taking shape, and for the first time since 2011, 2012, we actually have return forecasts that actually make buy zones more likely during stock studies and on our stock selection guides. But that's a fairly sudden and a fairly, I would say, fairly psychological damaging moment for many average investors that are out there. It's too sudden. It's too much too sudden. People. So what's the antidote? So I guess I'll just say one of the things I like to lean on is this presentation we've talked about many times at Manifest Investing. I think it captures what we do in our community. This happens to be a presentation made in San Francisco by Benjamin Graham back in November 1963. So again, 35 years ago. And Ben was bold enough to believe, unlike my lunchtime buddies the other day, that it is possible for people who think like us to do significantly better than the average investor. And those two things are required. You have to be sound, you got to be patient, you got to be diligent, and you got to be different. And I think a lot of the ways, a lot of the perspectives that we take are definitely different. And it's just a powerful reminder this time of year to invest better, to discover excellent companies and wait for them to be on sale. And that's one of the opportunities that we have with many companies, that they've gone on sale. Any thoughts on that, guys?
The biggest thing I've learned out of this is I'm never going to buy a stock at its 52-week low or be able to sell it at its 52-week high. But if you have enough, I have lots of alerts on stocks, so I don't have to follow the market. The email gets pushed to me to say, oh, this is a stock I was considering, and oh, it has gone down. So we're doing it. We're doing well at it. So it is possible. Patience. That's the hardest part, is sitting on your hands and doing nothing.
Okay, I'll just go ahead and track on. Again, I think our emphasis is to pay attention to what do our studies add up to, where are the opportunities among our studies, and this correction taken place during the fourth quarter of 2018 has now driven the average or the median Section 5 result of the stock selection guide up into the 12% range. That's going to put more companies in the buy zone. That's the way we look at the world. And in fact, I'll never forget a conversation I had with Mark Holbert a few years ago where we basically talked about this perspective. While everybody else is panicking, we're sitting there saying, well, where are the excellent, stable companies that have suddenly become more attractive from a price or a return perspective? And they're out there now. They're out there. Even companies like Apple have suddenly become attractive for some people who follow Apple. And there's a number of companies that here in the last 3 months have become fairly suddenly much more attractive as going back to 2011, that great correction that few of us can remember, and even almost back to the levels of that ugly time period back in 2008, 2009. It's hard to believe that we've come so far so fast on our Section 5 results. Any thoughts on that, Ken, or Cy, or Kim?
Well, I'm just thinking back to the last really big event that impacted my portfolio in a real negative way, and that, of course, was the Great Recession back in 2008, 2009. And I'm still not at the place, Mark, where I'm calling you every day saying, do you believe the results of what Manifest is showing and what our stock studies are showing? But I am encouraged by the fact that finding stocks to buy is a much more enjoyable pastime now than it was perhaps 18 months ago or 2 years ago.
And that's such a weird perspective. It's wonderful, though.
So I have to. Are you saying this morning that I've got to change my line from bears become blips to corrections become blips?
Or clinkers or something.
But you don't see it seriously on that, though. You don't see it as much on this chart. You could see it a little bit on the longer or the chart that compared my par and VL map, not VL map, the return on the value line arithmetic index. Where again you could see a little bit. I mean, take a look. That's the chart. Take a look at. You can't. It's a little difficult to see, but look at the magnitude of the drop in the last two green bars on this chart. Now go back and look at how you see none of that magnitude on this chart. You don't see it back in the .com bubble bursting in the early 2000s. and you really don't, you barely see it about the same. I guess if you go from October of 27 into 28, 29, you see about that magnitude. But again, below the trend line, it's much less. And again, that is back to the bears become blips. Now, a little bit of that is the fact that this is an arithmetic and not a logarithmic chart. But if you did it as a logarithmic chart, it would be even less magnitude. So again, what we have been through, living through it, is serious. And if you've not been through it, feels bad. But most of us on this call, among attendees and all of us on the panel, have been through the two that we just looked at, as well as the correction of 2011, and some of us go back even farther. And again, we just have to remember that market drops become blips over the long term. And one of these days, that probably won't be true, and the economy will completely go to hell, literally, and everything will fall apart. And I would posit that we would, at that point in time, whenever that day comes, we will have much more serious things to worry about than our stock portfolio. And I truthfully don't expect that for another few million years, so let's not worry about it.
So I'm guessing The Walking Dead have been filming in your parking lot again or something. Because they film very close to size parking lot.
Yes, they do.
Let's go ahead and press on. Just a quick reminder, looking at that opinion known as Morningstar, they also say that this is a multi-year buying opportunity. The average stock is on sale. And that's basically what get out there and find the companies in the mix. Just real quickly, let's roll through. These are the companies in the tracking portfolio. These are the top 20 by the size of the positions. The names that we've been mentioning: Cognizant, Microsoft, Apple. It is interesting to see Microsoft up at the top. These are companies that have the largest contribution to the portfolio. Again, the legend up at the top provides the number of times that they're selected. Every time they're selected by either a damsel or a knight or by audience vote, we invest $1,000 into them and log them in on that screen. So Cognizant's actually been selected 50 times. 15,000 has become 22,000. That's how you read that from top to bottom. And then we have a few like S&P Global, which Kim wanted to have work out tonight, but the $2,000 invested in S&P Global is now almost 6,000. So not necessarily in Kim's buy zone tonight, so she had to switch to another company. Some good companies on that chart, some off the radar screen. That's the way we like them, and we'd like to continue finding them. Any thoughts on the tracking portfolio?
I just I draw this to people's attention on a fairly regular basis, Mark, that these top 20 holdings weren't placed in there as a single time. Cognizant, for example, 15 times to get it to be 6% of the portfolio. But when we look at the size of these companies in the top 20, we realize that we're doing a nice job of looking at large companies, medium-sized companies, and there's some really good small companies on this list as well.
Yeah, I think Universal Display certainly fits that mold. That's a 3-time selection. Oh, actually 4 times now. I came back and did it one more time, I think. Oh, it's a 5-time selection now. Okay. Up here. All right, let's go ahead and press on. Now, we don't really have any stocks that are serious challenges in the pure sense of the word. These are the companies that on the worksheet for the dashboard have the lowest return forecasts. I don't think there's anything here to panic about unless any of my panelists disagree. We've done quite a bit of house cleaning. I think we can probably proceed into the end of the year without any more butchery.
I generally agree with that. particularly from this portfolio, for the purposes that we use it as a tracking portfolio, the one thing that I would just mention, if this happened to be a club or an individual portfolio, which of course it would not, because it's very unlikely that you would hold this many this many stocks, separate ones. But the portfolio as a whole is running about 3% above, or 3 points above my par, which is a bit below the goal. And you would want to perhaps boost it a little. And of course, normally what you would do is rank by reverse par, which is what you have done here. But notice that most of the companies with the low total returns going forward are relatively small holdings. And by that, I'm excluding ResMed and C.H. Robinson. Those are the only two that enter into the top 10 or top 15 holdings if you looked at it by the holding rankings. The rest of these are much smaller holdings. Where I was going is obviously ResMed, with the lowest potential return going forward, would be a typical potential sell candidate for evaluation if you wanted to boost your portfolio. The others, however, I would tend to say in a portfolio this size isn't going to have much of an impact, with the possible exception of C.H. Robinson. So you would need to jump down to that. So I'm just saying, if you have a large portfolio, if you have a portfolio that is similar to this one, in that the largest holdings have an inordinate amount of impact on the portfolio, to shift or to make an impact on your portfolio return, you've got to look at potentially selling some of your larger holdings. Of course, the lesson also in all of this is none of these are anywhere near the money market or even an extreme below market expected return. So the portfolio is very solid. So I had taken a look yesterday at the portfolio, looking at it from the perspective, if I were really trying to get this portfolio up to a 5, my par plus 5 points, it's tough. You would have to be looking at things like ResMed, C.H. Robinson, and then I really didn't go much beyond that. But my recollection is you would have to jump up to selling holdings that are expected to perform about market, and then replacing them with some high green, low yellow holdings. So in times of uncertainty, stability is a good thing. And so, as Kim has said a number of times on this hold, sometimes it's important to do nothing.
Cy, I performed the same diligence that you performed yesterday and the day before. What I was looking at, however, was the fact that I wanted to boost sales growth. And I looked at the bottom ranked by par, this exact list that Mark was talking about right here. This whole list of 7 or 8, I think I came up with 10 stocks at the bottom, represented about 11% of the portfolio, and every one of them had growth numbers that were beneath where my goal for sales growth in the portfolio was. I would like to see the sales growth in this portfolio move up to around 11.5%, 12%. And I considered in my mind, before coming to the same conclusion you did, which is do nothing, I considered recommending selling 8 or 9 just right off the bottom, just to boost the sales growth in the portfolio. And notice that whole growth list here is, what's 9 is the highest on the whole list right there. So you could do a little bit of boosting of your portfolio. And for those of you that are in Manifest, you can go and create a worksheet for the portfolio, and then you can play around with it by taking things out and putting things back in, and you can see exactly what impact you have on your averages. I could have boosted the sales growth to maybe 11.25, 11.3, which would be well on the way to getting where I think it should be.
That's an excellent point. Ken, in doing that. And notice that among these, again, we tend to accent growth, as you just said, and zero growth or average growth, if you will, is somewhere in the 4 to 5 to 6% range. Economy growing at 2 to 3% and inflation around 2% or so. We're have been historically a little below the 3% GDP growth recently, and we've been abnormally low on a historical basis on inflation, which gets us on that low end of 4. But kind of my rule of thumb has always been to get a slow growth company, that being a steady company that still has above average growth, is in the 6 to 7% range. And notice there aren't a lot of those companies, especially in the 7% range on this list.
Mark, Ann has a question. I'm going to unmute Ann Manning. Go ahead, Ann.
My question is, did either Cy or Ken, in looking at this, did you take out any of the companies on the worksheet and see what it did do to the growth?
Yeah, I took off, and Ann, my list was slightly longer than the list Mark has captured here. I think I had 9, maybe 10 companies off the bottom. So I went down 2 or 3 more companies, and it did push the growth up over 11% from where it is right now. I think right now the growth is at, I don't know, 10.6, something like that.
Did you notice what it did to the par?
I wasn't that concerned about the par. I view it in a way that if I can boost growth, par is going to kind of be dragged along with the growth. So I wasn't quite as concerned about par as I was about the growth itself. I thought that was the number that if I focused on that, I would eventually solve the par problem. I'm thinking of par right now as kind of a shorter term number because of all the ups and downs in the market going on right now.
Correct.
All right, I guess we can move on, but I do want to point out, again, we're just because there's a great case here. Costco Wholesale is a one-time selection made by Hugh McManus back in July 2010, I believe, maybe August. But that means $1,000 invested into Costco is now worth over $4,000. Again, that's just that makes up for a lot of clinking and clunking and all that other stuff you guys were talking about. I don't have much experience with that type of stuff, so I have to lean on you guys.
Okay, we're getting a good question just to clarify out of Joe right now, and Joe wants to know, is growth on the manifest charts, is that referring to sales or earnings? And Joe, that's referring to sales growth. On all these dashboards, when you see growth, that's sales growth, not earnings growth.
With one exception, when it's a bank or an insurance company, it could be book value growth. In the case of Bank of New York, that would be book value growth.
Jaya, I see your question, but I'm not sure. You need to look at what you typed. I'm not sure what kind of what you're referring to after the word further. It's capital M, small m. Maybe that means minimum. I'm not sure, though. So would you retype that to clarify that question, and then I'll get it asked for you? Mark, you can continue if you'd like then.
Okay. Just a real quick one. We also fall under the microscope companies that are lagging behind the market. There's only close to our 20% threshold that we've talked about in a number of companies like Coherent, Polaris, and a couple others are hovering right around 20. So I don't think we want to do too much with those. But the one that really disturbs me a little bit, probably mostly because I own some of this one, is Cy picked United Natural Foods 2 months ago. And it's not behaving well. It's actually down some 40-some%.
I was waiting for the clunkers to get to here. Thank you, Mark.
I'm not criticizing. I spent real money. You put theoretical dollars in. I invested real dollars, and back a couple months ago, it was in the 30s. It's now down around 10. I think this is a perfect example of the rule of 5 because mistakes like this. I mean, this company is clearly not following instructions or whatever. And I guess the big question that I have something like this, because the expected returns are now completely off the charts. 40, 50, 60% returns. This is what the company looks like on a visual analysis. I mean, we need to dig into this one a little bit deeper. Ken actually owned this one in the past. Probably dig in a little bit deeper and see if we can find some tragedy that's going on here, because it's not borne out expectations shown on this page, but the stock price has been absolutely, we're talking Custer's last stand massacre here.
Well, Mark, I'm gonna regret these, because these words are probably going to come back right at me another couple months or so. But I'm going to suggest that we set these trial triggers up for sales to help guard against rule of 5 stocks. And if the trigger's there, and if we're trying to have an honest experiment about these triggers, then hasn't United Natural Foods, hasn't it pulled the trigger, and shouldn't we be removing it from the portfolio?
Oh, it melted the trigger. It blew it.
That's what I'm saying. I mean, and you know, we have a number of examples that show that when you melt the trigger, you can sometimes melt the entire barrel of the gun in the next step downwards. So I would be in favor of removing. This is a small holding, of removing it from the portfolio.
Well, I can second that too. We can always tax loss come back to it in February if we end up doing it. But no, I hear you, Ken. I agree. I think we can actually go back and we can rub salt in our own wounds and say, what did this look like 30 days ago? And it probably was calling sold based on that discipline. Then we probably once again blinked. We got to really work on this. If we blinked on this one 30 days ago, we will look at that next month, or I'll add a post. We got to be better. Blink.
Well, Mark, you can think, if you wanted to, you could really think positive. You sell this for a tax loss to harvest it, so that next one, which you're going to have a 2 and 3 or 4 bagger, you'll already have your tax loss to offset it.
Well, yeah. If fair warning and full disclosure, I probably am this on Monday morning because I only have a few hours, and I don't know. I just don't get why the price performance is so bad on this one.
Yeah, I don't either. I spent a couple of minutes looking at it the last couple of days just to see if I could see anything clear. They were a little disappointing in a earnings report and expectations going forward, but nothing to this magnitude. Talking about melting triggers, though, and I just am asking for purity of process because I'm certain that it is over the 20% or 25% trigger, but it also just about perfectly corresponds to the 20% drop in the market as a whole. What is the negative relative return historically on this?
On this one right now, it's minus 47.
Relative?
Relative. Yeah, I know. I'm not kidding about the melting. It's 47. So we'll take a closer look at it to see how bad did we blink. I think it's a talk about in a month from now. But we jettison it and come back to it if it makes sense. But if it doesn't, fine. With that, we've got about 45 minutes to go, so I think we probably better head into our stock presentations. Kim is going to kick things off with, I think she described this one as a baby in the bathwater, so we'll let her make money for us. Go ahead, Kim.
All right. Yeah, we own Air Lease in our stock investment club that I'm involved in 2 clubs. We own it in one of the clubs. As Ken was talking about, our club doesn't meet in December because we meet late in the month and too many holidays, too much busyness getting done. So in November, we discussed, we have all this cash here. What would we like to add to our portfolio to balance out the portfolio for the investment club? we decided to put in a limit order on Air Lease, thinking it would never go that low because it was 20% below what the stock price was at the time, because we put in a buy order at 35. Lo and behold, as this slide says, Air Lease closed Friday at $29.73 with a trailing 12-month PE of 392. I can't remember the last time I saw a PE of 4. Can you believe it? So I really think that this could be a stock for us to have portfolios and making some money. And as I usually say, cha-ching, cha-ching. Let's move on. Next slide. They had their last quarterly report out was September the 30th, and they had sales were up 19.6% and earnings per share up 46.7%. Now, I don't know about any of you. I don't find any fault with any of those numbers. So this is from their slide presentation that they had November 9th from that last third quarter of 2018. They've got a lot of companies placed through the books. They've got a lot of liquidity. They've got they want to have their debt to equity ratio down below 2.5. They got it at 2.48. They've got their pre-tax return on equity at 16.8. Everything looks good there. They've got lots of planes on orders. Next slide. I never knew that airlines were leasing planes rather than buying them. I really like this slide showing how this, as Mark called, a disruption of an industry. Instead of buying them, the having airplanes leased is increasing, and it shows how this has gone on from 1970, it was only less than 1%. To 2017, you've got a rate there of almost 50 years, and now it's up to 40% of it. And why is that case? Those companies, those airlines need less cash, less financing, and it gives them more flexibility and eliminates the risk. And that's always good. And you have to remember, how many maybe recessions had we had in that, like 47 years? More than one. So the role of leasing is increasing, so this would be a company, an area that would be a little niche market that we could make money on. Next slide. They've got consistent asset growth because they've got a nice solid balance sheet, and I have been listening to the financial entertainment on TV, which is the markets, occasionally when I have the TV on. I've heard is, like, as we go forward, those companies who've got great balance sheets are the ones that are going to do better. Right here, a great balance sheet. Look at the growth, 14% there. Next one, next slide. They're expanding their fleet. They've got the consistent increase in revenue, third quarter 17 to third quarter 18. That was an increase of 20%. Nothing wrong there. Next slide. Their net income before their income taxes. There you go. Consistently, as Ken likes to say, up, straight, and parallel. I'm going to pull his words. Next slide. Okay, a lot of people are worried about leasing and the amount of debt. Well, they only own these planes for the first 1/3 of their life. They have a nice balance of all the different airplanes. They have twin engine, single aisle aircrafts. They only have the most popular aircraft in their portfolio. They have a lot of flexibility in the purchase agreement. Now, we all talk about how we want to have diversification. How can you be any more diversified when you've got a customer base of 94 different airlines as well as 56 countries? They monitor the receivables quite tightly to make sure that everything is addressed, and they've got their lease maturities spread out across all the years, so they have everything balanced out. Next slide. Their order book gives them lots of growth and you can see how they have scheduled out and how many they have delivered. When I looked at for the news for the last 6 weeks on Lease, I think I saw where they had delivered to 8 different companies. They delivered their airplane, so they're very consistent on that. And by that, they get lots of commitments. That's continued growth. Keep going. Next slide. About their financing. I can't complain with BB stable, A- stable. They've got their fleet. Young planes are only average of 3.8 years. They've got the diversified customer base. I mean, everything looks great. Next slide. And as their investment highlights show at the end of their presentation, they have a very conservative capital structure. They want to give great returns to their shareholders. So their order book is a great source of value. And look, they think that they're going to double the size of the fleet in 5 years. They've got great cash flow. 96% of their planes are placed in 2019, and they've got more online or more orders. They've got minimal lease expirations through the next several years. And here's the thing, this company, if those leases are canceled by the company, they have lots of penalties involved in that. If they have to have higher interest payments to charge the companies, those are all written in. They have a great return on equity for the company, and they've got liquidity of $4.7 billion. They've got their debt to equity low. They've got their rate of their debt fixed, and they've got a great investment grade from 3 different agencies. Next slide. I didn't even touch the Eagle off of Manifest Investing. Here it is. If you look at the return at the bottom, projected annual return is 20.4%. They say 5 years out, the PE ratio forecast could be 8.0. In the current PE4, that's another way of showing where you've got your capital appreciation to grow. That's a double there. Next slide. This is from Yahoo, where you get your key ratios. Notice where you have PEG ratio. You have a PEG ratio of less than 1. That's hard to find, period, and that's always great. And even more so, book value of $43.04. Book value, for those of you who may not be aware, is that means if you sell everything in the company for what are their assets, what is it worth? According to this, it's worth $42.04, and the stock is selling for $29 and change. That's like, what, 30% free money? It's outstanding. Next slide. Yes, the technicals look awful. The RSI is at that 28.12. The stock is obviously oversold. As Mark says, I really believe eventually we're going to see that great big white line going straight up and the stock price going up. I think this stock has been thrown out with the bathwater. I couldn't find an airplane to put over the baby there. So I hope you would consider to have Lease added to your portfolio. Thank you.
Well, thank you, Kim. Well, this one's been a community favorite for a few years. I think what I'm tempted to do is put together a montage of Matt Spielman coverage of the company, because he's not seeing any danger or ominous signs. He certainly would tell us if he did. And I don't know, we were trying to come up with why is it behaving like this. I think it's just an overreaction to the interest rate sensitivity, which, as Kim covered, they don't have that exposure. So I think it's probably an overreaction to rising interest rates. What we shall see, and talk about this one going forward too, I'm sure. So with that, let's go ahead and switch to 2-6 Corporation. It's a repeat selection for the portfolio. Take us away, Reverend Lynch.
All right, thank you, Mark. I'll try and move through relatively quickly through my slides, since anyone here last month saw this presentation, and it's basically the same thing. You can see pretty consistent sales and earnings growth over the last 10 years. So we like that consistency. Next slide. I decided this month that I would probably make a repeat selection. I was sorely tempted to do Cognizant just to tweak everybody, but since it wasn't in the green zone, I figured I would pass on it for now. So this is the portfolio ranked by par. I've taken out some of the yellows. I decided I didn't want to shop in the yellow. So then I just skimmed down, then looking in the greens. Of course, you see Kim's pick, Air Lease is there. EPAM Systems is certainly a reasonable candidate as well, with a good potential return. But I was looking for things that I knew, and after EPAM, you get down to 2.6 into IPG Photonics. But also, I just thought about something we've anecdotally talked about a few times, of how we've made good picks, Universal Display being one of them, but Costco is another example that we talked about, one-time picks that had done very well over time, and how it would be nice to have accumulated perhaps a little bit more. So I said if 2.6 was good last month, it's certainly something to consider this month. And since it was right next to IPG Photonics in the portfolio ranked by par, which is a similar, although not identical, company, I just ran the two of them together, and you can see across the board the metrics are quite similar. Growth is within a tenth of a percentage point, as is the par. Quality, both are in the 90s, very good. The earning stability on 2.6 is just a little bit lower, is the main differentiator between the two. And also 2.6 has a slightly lower projected PE, giving me a little bit more confidence, although again, nothing major. And I'll leave the rest of the discussion to IPG to Ken in his presentation. Next slide. So I did just quick industry studies on both of the companies, just to make sure, excuse me, that there wasn't a better opportunity perhaps in a competitor. You can see here IPG's industry. Everybody with higher returns than IPG are in quality zones that, with the possible exception of Lam, I wouldn't even consider at this point, Lam and Applied Materials. And so, and Applied Material and Lam both have lower financial strengths that I'm interested in right now. So I don't see a better opportunity in that industry. Next slide. And then for 2.6's industry, again, MKS is a little bit better return, but it was in the yellow. I decided not to shop there. Also, a low financial strength. You have Neogen and Cognex, slightly better quality in the industry, but lower returns. So each of these quick industry studies confirm that, at least within their industries, 2.6 and IPG Photonics are the two best candidates, and I already explained why I went with 2.6 over IPG. Primarily the fact that it's a new pick and we only have one holding, because the metrics are about the same. Next slide. Here's the company. They manufacture various materials in the optoelectric and laser areas, and they're used in all sorts of applications that you can see here, and we'll see graphically in a moment. They have three segments: photonics, laser solutions, and performance products. Next slide. Kim mentioned diversification. within a company's portfolio. This shows reasonable diversification on a geographic basis, with a little less than half of revenue coming from North America and the rest spread throughout the world. You can see the three segments are not quite a third, and a third, a little bit heavy on the photonics, a little bit less in the performance. And but again, well diversified. And then in their markets, the last slide, they're pretty heavy in the industrial, which is the lasers as a manufacturing tool for semiconductors and so forth, and the optical communications, which I'll talk more about in just a moment, but that's primarily cell phone, 3D sensing, and automotive laser distance detection. Next slide. The big news that had broken last month is that II-VI is proposing a merger with Finisar that will roughly double the size of the company. Finisar, you can see here a description of it. It's primarily in the industrial and the communications markets that II-VI is in. Probably the biggest complementary area is in that optical communications area, specifically the 3D laser sensing, and the it's on this slide, the LiDAR, which is a laser distance detection. Essentially what those two things are, and this is where II-VI believes Finisar will bring new markets and new revenues to complement already strong areas with II-VI. The 3D sensing, their biggest customer is Apple for the iPhone facial recognition. The LiDAR is automotive applications, which is again for the sensing of distance for automatic or warning systems for braking in getting too close to cars, or for sensing vehicles around you, or for automatic parking modes. Those are the applications that are being put to those particular products. If you want to see more detail, go to the II-VI site. They've got a much more detailed PowerPoint presentation that these slides are taken from, that if you really want to get buried in detail, it will show you the various products and product lines of the two companies and how they mesh together. Next slide. Again, I used this slide last month and show it again to show that II-VI has grown through acquisition as well as organically over its history, and has done it successfully, so we can trust management to do well with the Finisar acquisition as well. Next slide. This just gives you a picture of what the company will look like. Biggest same pro forma revenue of $2.5 billion, which is about a doubling in size. Again, a worldwide company, and it's not shown on this slide. I think it's the next slide. The cost savings that they believe will be associated with the merger. Next slide. Yes, the bottom line. Again, this just summarizes some of the strategic reasons for the merger. I've mentioned very much the about the middle there creates the most compelling 3D sensing and LiDAR platform. That's an area they believe will be growing very rapidly, and that those are two strengths of both companies, but they're complementary strengths, and they believe it will position them to grow well in that area. And then again, they expect to be able to improve margins over both companies' historical rates due to synergies. And again, the presentation on the website goes down into some detail where they expect those savings to come from. Next slide. And then here's the three judgments on the Eagle. And the bottom line, I left my judgments the same as last month. This is roughly the same as the manifest analyst consensus, with the exception of net margin. I didn't go quite as ambitious with the margin improvement as the analysts have, and get a strong 16.5% potential total return, which as of yesterday, you can see the sweet spot started at 16.6, so it's right at 5 percentage points above my par. So I'm doubling down on my pick 426 for the portfolio, and suggest that the audience go along and make it a double-double.
Ever campaigning. Well, I'm sure Pittsburgh thanks you, and the Pittsburgh chapter of Better Investing thanks you.
Yep. And I'll go ahead and throw it out, Mark. I did not realize it, but Finisar is also a Pittsburgh company, so this is a double Pittsburgh pick.
There you go. All right. Next up, Kenny's going to talk about the overall portfolio and his selection, which is pretty close to size.
Sure. I've chosen IPG Photonics as my stock to present this evening. I presented this about 3 months ago, and Mark, if you'll go to my slides. There we go. Here's how I came up with IPGP. I did a stock search, and Mark, this is the second slide in my stack. Can you go back one slide? There we go. I did a stock search in Manifest, and I asked for par of 16 or better, quality of 80 or better, financial strength of 80 or better, growth of 12% or better, and earning stability of 70 or better. This is a pretty standard screen that I run to come up with ideas to purchase, and the results of that screen were fairly short. Next slide, Mark. It contained these 7 or 8 companies right here. I was familiar with every single one of them. I kind of steered away from the financial company at the bottom of the list, although I find brokerage houses to be a very compelling story right now that you might want to do an industry study on. I belong to a club that just bought into Cantel Medical. We really liked that company. The clubs that I'm involved in own Align, EPAM, Alliance Data Systems, and Booking.com, all of those. And we also own IPG Photonics in one of the clubs that I'm involved with. I was familiar with it and had the same idea that Cy did, that if it was good 3 months ago, it's probably really good today. That, you know, sometimes has some danger with that kind of thinking, because you can, the brokerage houses talk about catching a falling knife. You can, in fact, be grabbing something that's going to continue to fall real hard. But I liked what I saw before, so I did some more study on it. Next slide, please. I went back to their website and looked at the most recent investor presentation. This presentation is from the middle of November, so it's about a month old right now. And I focused on the very first slide in the presentation. I had kind of glossed over this slide the first time I presented IPGP to the roundtable, but now I wanted to know the difference between traditional lasers and these fiber lasers that IPG works with. They had given me some single and phraseology at the bottom of the two categories to guide me, but I wanted a little bit more information, so I Googled, tell me the difference between traditional lasers and fiber lasers. Next slide, Mark. Next slide, please. There we go. And I ended up with some really great information from a number of different sources. I chose this one because it was kind of concise and I was able to do some underlining in it for you right here. But why would you choose a fiber laser over a traditional carbon dioxide laser? And the first reason is it's energy efficient. It cuts faster and requires less total maintenance than a traditional laser. Overall, the time and expense needed to maintain the carbon dioxide laser is huge and complicated, and you compare that to the maintenance of a fiber laser where they have to deal with the nozzle, the protective lens cover, and the water filter, which are low-cost items and easy to replace. On top of that, you get an extreme difference in energy efficiency, and you get much more cutting capability. These fiber lasers can cut material 2 and 3 as much as 8 times thicker than the traditional carbon dioxide laser can cut. Next slide, please. So that gave me some real reasons why I should look at a company that is firmly dealing with these fiber lasers. And then this second slide in the deck on the investor presentation gave me some really good ideas about where the growth for this company was going to come from. First of all, it was just pure conversion from non-laser traditional kinds of cutting of materials to laser-based systems. Only 18% of the machining and tooling being done in the world right now is being done with lasers. Well, you look at the complement of that number, and there's 82% potential market then for traditional cutting to become laser-based cutting. And then on top of that, the traditional laser is being replaced by fiber lasers. Almost all of the new business is coming from fiber laser, and they're also picking up business as companies transition from the traditional carbon dioxide laser to the fiber laser. Again, energy efficiency, able to cut more material much more quickly, and much, much cheaper to maintain the fiber laser versus the other type. Next slide, please. One more slide, please. There we go. IPGP has the largest portfolio of fiber lasers of any company in the world. And you can see that these lasers are categorized by how fast the pulse is to do the cutting. So you go to extremely fast pulses from peak power down to pulses that are fairly slow. And depending on what you're cutting, that depends on how you want to make the cut, how you're going to make it happen. A pulse is just like a beat of a heart or the tick of a clock, but these are measured in milliseconds and nanoseconds rather than in single seconds. It goes from X-ray length, which are really long, really short wavelengths, to infrared rays, which are fairly long rays. So the complete portfolio is right here in IPG. Next slide. I loved the first piece on this slide right here. 270 patents held by the company, 420 patents pending right now for this company. That means that a lot of their new innovation is protected and is going to be protected for a fairly long period of time. On top of that, it's the lowest cost provider in the world of fiber lasers, and they're shipping literally thousands of lasers every quarter. It has a fairly large footprint in sales, so you put that all together, you end up with some significant barriers to entry. Morningstar would call that a moat around the company. Next slide, please. We look at where the company is doing its business, about 44% of it in China. And then you can read that graph. It's the large circle at the bottom of this slide right here. The little dots on the world map show where it's doing business, whether it's a service position or whether it's one of its main offices or or whatever, and you can see that they're a worldwide company, and they're not dominated in the U.S. It does business in the U.S. It's a U.S. company, but it's doing significant business outside our own borders. Next slide. Here's the graph, fairly consistent. A little bit of a slowdown in the very last quarter, tied to some slowdown in China. North America actually grew by more than 30% in that last quarter, but China declined a little bit, and Europe had a significant decline in the last quarter. So as you do business globally, you have to watch all of your markets, and there was a slight decline in the market. Next slide. I love to look at the Chronicle for all my stocks, and I want to see a nice steady blue line. Blue line is quality, and I want to see my stocks maintaining a nice, dull, boring, horizontal quality line. This stock has maintained its quality up around 97, 98, 99 now for 4 or 5 years, okay? I put down what the quality and par were as of yesterday, and the quality was 99 and the par was 18.5. If you look at that end of the red line shows par, and the last dot on this graph would be the par at the end of November of 2018, and that par looks to be a little bit under 15%. We're going to get another red dot after trading on the 31st, but the par is likely to be somewhere around 18% for that new red dot, and I'm telling myself, that's an all-time high when it comes to par values. Now, I also know that there's a brand new value line dated yesterday on this company, and value line pulled back on some of its numbers. If the other analysts are equally concerned about a little bit of slowdown, then that might change some of the manifest numbers, and we might have par slightly lower than the 18. But anytime I'm getting par up around 15, 16, 17, I'm pretty happy in this particular market. Next slide, please. My results from my SSG that I did, 5-to-1 upside downside, returned somewhere between 12.5 and 19.5. Again, very pleased with that return. There's what Value Line says. They predict return somewhere between 9 and 21%. They're giving it a 5 right now. They're saying that near term, next 6 to 9 to 12 months, this stock will experience growth slower than the market, but long term, if you read the entire brand new report, long term they expect this company to be overwhelmingly positive, and they expect that the strength of its patent protection and the strength of its innovation should continue to allow it to take customers from other companies doing the same kind of work. I'm looking at the IPG numbers again that I repeated from Manifest, quality of 99, par of 18.5. These numbers all seem to be speaking to each other. I'm well aware that Mark will be updating IPG next week, and this par might change a little bit, but I'm fairly happy with the par return right now, so I'm suggesting another position in IPG Photonics.
Very good. Thank you, Ken. I learned something this morning. They're the LED of the laser business, apparently. Good stuff. I'll give the Reader's Digest version because we are running a little bit short on time, but just a real quick look. So far, you guys in the audience have heard 3 repeat selections that are already in the portfolio. I'm here to give you a bold, fresh new one for this holiday season. All I did was take and subject the database best investing to what we call the ivory soap screen. We're looking for companies that top 0.5% with respect to quality, ranking, and their return forecast. So we're looking for companies that have both very excellent quality characteristics, and elevated return forecasting. It's an excellent list. You'll see most of the companies presented here this morning actually make this list, or they're just barely off of it. And I'm not going to get terribly complicated. I'm just going to say, what the heck? I think with the way the stocks have been beaten down, you just roll with the punches, go with some that have been beaten up the most, that have the best outlooks for the future, and go with the top one on the list. That's Nvidia Corporation. The ticker symbol is NVDA. They are kind of a darling stock over the last several years because they are connected in technological ways to the Bitcoin situation, which is really just the entree to a future of probably a change in finance with the way that stuff is all handled. These guys actually are engaged in that, along with advanced gaming. These guys are the chip makers for many of the advanced gaming and simulation technologies. So they're attractive. They've been bandied about for a number of years. You'll see why here in a second. On the top, you're looking at the price chart. Again, they were a darling stock over the last 5 years. They shot up dramatically in 2016, 2017. And I'm just kind of wondering if this correction and this running for the exits and panic and turmoil that's gone on in the last quarter isn't what is sometimes referred to as a second shot at the basket. For those of us that wanted to buy this company 5 years ago, but the stock price kind of got away from us, well, it's come back to us. If you're patient enough to wait, you can see that long, peaked out relative strength index up at the very top. Well, it's come back down into average ranges where the price is potentially more appetizing to some people. I like the fact, as Ken was talking about the Chronicle, that the quality on this company has been steadily increasing. That means their balance sheet's been getting steadily stronger. Their competitive characteristics against their peers and competitors getting steadily stronger. Balance sheet's probably all right too. And again, with this price drop, you can see that the advance in the stock price did bottom out the projected return in the last couple of years, but now the dip in the stock price has given us an opportunity in that long-term perspective of something closer to 20%. Here's what the company looks like fundamentally. It is going to be a bit of a roller coaster. It's going to bounce around a little bit. We should not be surprised by that. The overall trend from 35,000 feet for this company, again, it makes some very high performance, very high demand chips for some areas that are actually exhibiting a fair amount of growth. You can see that the sales and earnings have been a little bit bumpy, but definitely in the right direction. You can see that the profitability on the lower left has perhaps plateaued, but plateaued in a very nice area. 30-40% net margins is very strong. And again, the PE, again, something in that 20 to 25 range would be very strong for a technology leader like Nvidia. You can see that just over the course of the last year, the stock price has gone down, 20 or 30%, while the company continued to grow and actually had a slight increase in growth expectations according to Value Line, slight increases in expectations for profitability, and the PE has remained basically the same. So the net result of that drop in the stock price for a company that is actually continuing to perform pretty well means that it's come back into a range that could be attractive to some of us. Here from the Value Line report, I'm not going to read the whole thing. It's just everything here basically just says everything's firing on all cylinders, the stock, except for the stock price. Their sales are increasing well. Their profitability is improving as they take costs out of the business. They continue to surprise on the quarterly results. They continue to remain committed to research and development. They're not skimming anything off there to try to make something look good. Again, we're talking about earnings growing in high double digits. And again, the last statement from the Value Line closed, these neutrally ranked shares, according to Value Line, may appeal to, and what a wonderful word this time of year, patient investors, that's us. Following the equity sharp price correction from the 200s back into the 100s, we now are looking at decent recovery potential, and they're talking about an increase in stock price through the next 3 to 5 years. So we don't have this one in there. I think we can stand a little bit more growth than as Ken was asking for earlier, and this is the type of company that can provide a potential for very strong growth and ultimately strong performance. So I'm going to add Nvidia, ticker symbol NVDA, to the portfolio. So with that, Ken, I think we can go ahead and segue into the poll. Ken?
I'm doing it right now, Mark. It's just taking time to come up here. Hold on.
You're like a silent Santa Claus.
It doesn't want to launch. There we go. It launched. Okay. All we want you to do, folks, is take your mouse, or if you're on a touch screen, your finger, and choose one of these as a possible addition to our roundtable portfolio.
You know, I say this all the time, but wow, I think these are 4 ideas that are really worthy of study. I like the fact that Kim was talking about a company that with a salvage value 30% below its current asking price. I'm not lobbying for Kim. You guys should be focusing in on the company I presented. But I think they're all worthy of...
Okay, I'm going to give you about 3 more seconds, folks. And that pushed us over 90% voting, so I'm going to close the poll. And I'm going to share the results. And it looks like we're going to add a position in Lease to the roundtable portfolio, and a pretty close heat among the other 3 at about, give or take 20% on the other 3. So I think people are agreeing that we have some good choices this time, Mark.
Yep, that's a really cool result, and I think I will make good on my thoughts about putting together a Matt Spielman montage of the stuff, because if you may recall, this is the one that Matt presented years ago, where he talked about he was the founder of Lease, was by one company, walked across the parking lot and formed the Lease as a competitor. Interesting.
Yeah,
story.
what you're looking at right now is just a holding slide, folks. So Mark will hit the next slide and show us where we're going to be appearing soon. Mark and I will be in Chicago in March. Our January roundtable is coming up. Oops, you went right through it there.
Ken, go ahead.
There we go. Okay. And then we're going to be in Pittsburgh in May, up in Traverse City in June. In April sometime, we will be having a session with Southeastern Michigan and Mid-Michigan. It'll be at Baker College. And Cy is going to be in Sacramento. Cy, what's that date again?
February the 9th.
Okay, so on February 9th, we'll see you in Sacramento. Our next roundtable will be back to our normal Tuesday on January 29th. And we're not going to be running a Turnout Tuesday in the next couple of weeks or so in deference to the holidays, but we'll be bringing Turnout Tuesday back again sometime in February. So with that, what we usually do is we close down the recording, but we'll stay and try to answer your questions. Kim and I, we're gonna be in Atlanta in August. Atlanta in August. There's something wrong with that phraseology. I'm just not sure what it is.
You can add Cy to that too. I'm participating, but
Cy's going to be there as well, Mark. Okay.
Even if I live here, they decided they would invite me.
Well, that's an especially good reason to invite you.
I figured you might be on the grades.
Okay, so I'm going to pull up my questions box here and try to get some of these questions answered, okay? Let's see what we can find out here and what we can answer. Gabriel wants to know, Kim, does Air Lease have a positive free cash flow? Kim, you might be muted. Okay. I believe that Kim indicated the cash flow was positive for Air Lease, but I wouldn't stake everything on it. That's a number you can find fairly quickly by looking at a value line report or looking probably on the Air Lease website itself. Milo wants to know, hi Milo, how you doing? Milo belongs to a couple of investment clubs that I'm in. How will the markets go down? Will the markets go down because companies cannot buy back their stock after January? I'm not sure that's true, Milo. I think companies can buy back their stock whenever their board chooses to make that purchase. It'll just go on a different fiscal year. Mark, am I telling tales, or is that basically true?
I'm not sure what the disruption that Milo is referring to is, but I'm not aware of anything material. Okay, we can look deeper.
Okay. John wants to know, has IPG had to transfer their technology to China? IPG manufactures all over the world, and to my knowledge, they haven't had to make any transfer of their intellectual properties in order to build these plants in China. And that answers another question. Somebody said IPG might be hurt if the Chinese put tariffs on import of their products, but IPG manufactures a lot of their products in China, which means there wouldn't be a tariff for use of that product because it's being manufactured in China itself. IPG is truly global, as you can see by that one slide that I put out there about where their manufacturing capabilities are and where their offices are. Tom says, I heard that companies cannot buy back stock during the blackout period just prior to an earnings release. And Tom, there are restricted times during the year when companies cannot do a number of different things, including buy back stocks. So you're hearing correctly, but those are tied to specific parts of the calendar when the company is reporting various financial information. And remember, that's not uniform because fiscal years aren't uniform. Let's see if I can pick up another question here. Kim, Kim, are you there?
Well, we must have lost her. I did pull.
Yep. Kim, are you muted on your side, Kim? Because we can see that you're not muted on our side here. Kim? Oh, okay, we'll leave her question up. No, Shirley wants to know, can you define photonics? Well, in the most general terms, photonics is something that uses photons to make whatever it is work, and that refers in large part to lasers. Lasers are, you excite photons, which are subatomic particles. Let's not get into the weeds here. You excite photons and they begin to move very quickly, and they can generate a lot of different properties, including a heat, and that heat can be used to cut things with them. Jaya wants to know, Sai, can you explain a little bit about what you meant when you said that the returns on some of those lower return stocks were not even close to money market returns?
Sure, I'll be glad to. First of all, money market returns right now are somewhere between a half, even some. I think I noticed a national average even down in the third or so of a percentage point, up to 2%. So let's just, as a ballpark figure, say that you can get 2% from your bank or for a money market account or something. So that's what I meant by money market return. Now, where the relevance of what I was saying is that for what we generally term core holdings, that is for a company that is not speculative, not some sort of a special situation, but a what you might call a blue chip, a well-established core holding. The main time that you would consider selling that company based on valuation of the company is when you could do just as well in a risk-free or largely risk-free investment like a money market return. For right now, that would be a 2% or so return. So as you can see, none of these companies are close to that. Now, of course, most of what Ken and I talked about, me focusing on par return, Ken focusing on growth, was referring not to individual company growth or return, but portfolio return and seeking to boost the portfolio return. There's two reasons that you might sell a company based on valuation. One is to boost the portfolio return. The other is because the company itself has such a low return, you would want to sell it. And so that hopefully gives you the rationale and the detail of what I was referring to. The Reader's Digest version is none of the companies we were looking at selling are anywhere close to as low a return as 2% that you could get in a money market. So based on that selling criteria, we would not be looking at selling any of them, because I think all of the companies on that list, if I recall it, I would consider core holdings. Looking at it, yep, I think most of those pretty much are core holdings.
Hey, Kim, are you there yet? Can you speak to us? No, she's still not there. George is telling us that the Air Lease free cash flow, and he evidently looked it up, is actually negative. So strike that when I said I thought I remembered it was positive, because I didn't remember correctly. So George is telling us that the free cash flow for Air Lease is actually negative. And again, that's a relatively easy number to look up in any data source. You should be able to find that fairly quickly. I'm answering a question now from Cheryl, and she wants to know, how can you get Value Line so you can do a full analysis on Air Lease? And Cheryl, you can subscribe to Value Line. It's a subscription, fairly expensive subscription, but I would start by going to my local library and seeing if they had a either paper subscription or an online subscription. My library happens to have a free access to an online subscription for Value Line, so I can look at Value Line reports right from the comfort of my own home. So I'd start with my library. If that's not successful, maybe look at some libraries that are in close towns to you. Sometimes you can get a card that will allow you to use a library even if you're not a resident of that particular place.
No, Ken, I think her question, and Roy, I believe, echoed it later on. It was a little confusing to me when I first saw Roy's, but I believe he's referring back to Cheryl, is the full, put it in the full edition rather than the expanded edition.
Oh, is it in the full edition right now, Ty?
No, it is. That was her question. How can you convince them to move it into the full edition?
Well, my experience with Value Line is that they're not really customer responsive. So you can give them a call and you can ask them, but they have their own reasons for doing things. And I think when it happens, it happens. But I don't know if you're going to nudge them very much by just asking for it to happen. Jaya would like to know, and this is a good one for Mark or Cy or Kim to take, how do we differentiate value stocks that are on sale between value stocks that are not on sale?
Well, I determine stocks by their projected return, and so if a stock is has projected return above the market, then it is certainly something I would consider. And again, normally my criteria, as kind of our suggested, is shooting for companies that run roughly 5 percentage points above my par, and that would be true of a value stock or a growth company. I mean, anytime I'm looking for a company on sale, I'm looking for it somewhere in that 5 percentage points and higher above my par. Now, if you want to get into the growth and value, I might have some more comments, but I'll hush and let Mark or somebody else give an opinion on how you value stocks and determine if they're on sale.
I don't think there's a separate set of rules for value stocks, and that's kind of what this is getting to. We recently presented a presentation by Joel Greenblatt. We shared that he'd actually did a presentation at the Chicago Financial Analyst. One of the things he said that day when he talked about the value investors and the infamous and the notorious investor, but he even goes on to say that's not what he does. He combines growth investing and value investing, which is what we do, and he actually referred to it as valuation investing, which is kind of the answer that Cy just gave. You could say that a value stock is a lower growth rate company or whatever. We call them stalwarts or mature. There is no difference. You basically model the company, take a look at the visual analysis, and figure out if the return forecast is better than you would get from something else. So that's how you determine whether a stock's on sale or not. How does its return forecast compare to others? And I don't care whether it's what someone might call a value stock or growth stock. And by the way, sometimes they get confused about which is which.
Okay, Ben. Ben, I think you misheard a number of different people. Ben is saying that we said that the growth numbers that manifest are for revenue, and that's exactly the opposite is true, Ben. The growth numbers that you see at Manifest on Manifest charts are sales growth. Revenue, sales. Boy, oh boy, Ken, are you being stupid right now?
Put down that eggnog.
Ben, you're right, okay? And he wants to know, is it total revenue or per share revenue? And I think that that's the same thing, whether it's growing per share or total revenue growth, it's basically the same, although I understand that if the shares are changing, then the growth rates per share will change slightly. Mark, are you giving us an idea whether it's total revenue or per share revenue growth?
It is total revenue. We do make when we do an occasional cash flow analysis, price to cash, we do for Amazon. We do use sales per share for Amazon in that type of instance. But 99% of the time, for an industrial company, it's total sales.
I would also point out who did you say that question was? George?
Ben.
Ben, I'm sorry.
Yeah.
Yes, Ben, his observation is very good in that if you don't look at revenues per share historically, you can have some distorted growth calculations if you've got mergers and divestitures and so forth going on there. However, we're looking, first of all, at projected growth rates, not historical growth rates, although we may get some of the projections may be based on historical rates, but we're looking projected. And while, like Mark said, it is total sales growth, of course, the number we're really shooting for is that earnings per share, to come up with a projected earnings per share that we then multiply by the market valuation, otherwise known as a price to earnings ratio, to come up with a projected future price. So any distortion based on share changes is going to end up washing out from a projected standpoint, because that's taken into account during the earnings per share. So the observation is very good and is an important one to make if you're looking at historical sales growth for a company that has experienced a lot of mergers and acquisitions. On the other hand, the way our methodology works for projected, it really, as I think both Ken and Mark said, it's not going to make a whole lot of difference going forward because most of us aren't making major sales growth projections based on mergers and acquisitions that we're not aware of and that nobody has dreamed of. But even to the extent like in an IPG Photonics or some other place where shares did matter, that's going to be taken into account in the earnings per share calculation.
Kay would like to know from anybody that feels free to answer it, is negative free cash flow a problem?
No, it's not. What you're basically looking at. In fact, we had Air Lease up there a few minutes. They have positive cash flow. They have negative. The difference is the amount they're spending on capital expenditures. And just like anything else, you probably would want to trend the two and compare them. But we're basically just talking about what they're investing back in the business from their cash flow. That's how you get to that free cash flow number. So George is right. It's a negative free cash flow, positive cash flow in the definition that Value Line uses. But no, it's just a measure of how they're investing. Let's take a look at Amazon just real quick. I assume Amazon's got negative free cash flow. Do you happen to know, Si?
I was muted, but no, I do not know off the top of my head.
We'll use Amazon as an example. And then I'd like to reinforce a point that Ken was just making. Here you can see that Amazon, these cash flow numbers that you can see up at the top here, and their capital spending, it actually comes in under a little bit. Historically, it's been higher. Their capital spending has been greater than their cash flow, generating that negative free cash flow number that you're kicking around. So it's not necessarily a problem. You just have to look at it in perspective, keep it in context, and as Kim was saying, you're going to see that in the long-term returns on assets, returns to shareholders. So the other thing is, Value Line does use revenues per share for these companies. And again, the revenues per share growth rates can differ from what you see. One of the reasons why you shouldn't compare your total revenue number to this one down here is this is revenue per share. So this one will reflect the changes in share numbers, whereas on a stock selection guide, you're graphing total revenues. So again, the impact on changing in share amounts impacts the box, not necessarily reflective of what's on your SSG. Sometimes that's where the differences come from.
Okay, Roger would like to know, what are my comments about Neogen going from 90 to 55? And Roger, with a big smile on my face, I'm just going to remind you and the rest of the folks in the audience that stock prices fluctuate. I have not seen anything to change my opinion of Neogen's management or of Neogen itself, except for the fact that its PE has become much more reasonable in the present time. I'll admit that I was selling some of my Neogen as the PE crept over 40 and then over 50 and almost to 60. I was selling some of that stock on the way to its overvalued, in my opinion, its overvalued status. And now that it's moved back and kind of put itself back together again at a much lower PE, I've been adding a few shares here and a few shares there as the par moves into mid-teens. So stock prices fluctuate. It's part of what the market does to stocks occasionally. And I don't see anything at all to change my opinion of the company or its management at the present time. Any other comments on Neogen from anybody else?
I don't follow the company, but when you started talking about PEs in the 50s and 60s, I'm saying, of course, it's going to drop with the turbulence that we've seen in the market.
Absolutely, yeah, and that's why I think that you know, you have to keep reminding yourself that better investors are not necessarily people that buy a stock and put it away and let it sit there forever without even considering what's happening to it. There are times to sell, and sometimes stocks hand you piles of money when they become extremely overvalued, and many times the PE is helping you determine whether or not that stock is overvalued or not.
Yeah, I would just mention two things that I consider this maybe a second shot at the basket again, because Mark and Wendy missed out on Neogen a few years ago and opportunity. And we also recently did an analysis on paychecks and looked back at the 1990s and early 2000s, and in an effort to understand that PE for lack of a better word, normalized for a company like Neogen. And, sure enough, you can take a look and learn something from the case study, paychecks, and just what ultimately is going to happen to, a high quality. This is an excellent quality company.
Cy, this one's for you. Joe wants to know, he's heard that there's a lot of Russian influence in the 2.6 management. Do you know anything about that, and do you have any concerns about it?
If I knew anything about it, I might or might not have concerns about it, but I'm not aware at all. I did see the question pop up and just very quickly pulled up some bio information both on S&P and on the company website. And everybody in senior management are longtime American company and apparent American residents and American educated. So what their ultimate heritage is, I don't know, but they certainly have not just moved here from Russia. But I don't know anything about that. Okay.
Butch wants to know, am I concerned by 44% of IPG's sales going to China? And no, if it's a healthy market in China, if they're manufacturing in China, employing Chinese people and selling to the Chinese people, I think that's as healthy as, say, Mercedes-Benz putting a huge auto plant in the United States and manufacturing cars here and selling those cars to Americans. It doesn't particularly bother me, but I do understand that a slowdown in China, which happened recently for the first time in a number of years, I do understand that a slowdown in China will impact IPG a little bit more than it might impact some other companies that don't have that amount of sales in China. I guess that I could rephrase the question, and if the company in fact sold 44% in the United States and the US had a slowdown, would I be really concerned about it? And my answer is no, I wouldn't really be concerned. I would know what was happening, and I could evaluate what's happening based on what I knew at that point then. So no, I'm not concerned that the 44% of their business comes from China. I'm clearing the question box here, Mark. I don't have any other question. Ben says, IPG has good local competition in China. The government might push locals to use their domestic manufacturers. I'm just going to push back just a little bit, Ben, and make the point that IPG is the largest manufacturer of the fiber lasers. And I had been thinking a lot less, with a lot less sophistication a couple of years ago when I first purchased IPG. I had been thinking that it probably had competition from a lot of companies throughout the world. I come to find out that folks that are making the fiber lasers, there's not as nearly as many of them, and IPG is really the giant in the room when it comes to that kind of laser. So I'm not sure that they're meeting significant competition anywhere in the world for the fiber laser. Remember, that's still a small part of all laser machining that's being done. It's less than 20% of all laser machining being done, but there are definite advantages to the fiber laser over the older carbon dioxide laser.
Well,
hey, Ben is assuring me that the good Chinese companies are there and they're growing. So, Ben, I'll take your word for it.
There's a lot of room for growth. Well, I just have to pile on and just have an observation. My year 2018 is because Ken Cavula used unified field station a month ago. And now here he is defending a Chinese enterprise. So 2018 is now complete. We can set off the fireworks and move on.
We also talked about photons, Mark, okay?
Mhm.
I got that.
Uh-oh, there you go using a P word,
Another one. Okay.
especially Chinese P words. We got to watch that,
Oh
Ken.
dear, oh dear. They're referring to Chinese pork and a company that I recommended years ago that I'm never going to live down. So I don't have any more questions coming up. It appears that we're all set. We're getting some thanks from everybody here. Thank you in return for showing up this morning. And we'll see you again near the end, the last Tuesday in January, and the roundtable will reconvene at that point. Cy, Kim, Mark, thank you so much for helping. We really appreciate this, and Happy New Year to everybody.
Happy New Year.
Thanks. Happy New Year's all.
Good afternoon, folks.